Hey there. Did you know that nearly 80% of Americans are living paycheck to paycheck? Crazy, right? If you've ever felt overwhelmed by money issues, trust me, you're not alone. So, let's talk about hedge fund strategies. You might be wondering, what do those fancy Wall Street moves have to do with your everyday finances? Well, they can actually help tackle some of the money struggles we all face. Stick around and I'll show you how. All right, let's dive into the real talk here. Money issues are super common these days. A lot of people are dealing with debt, feeling like they can never save enough, or completely confused about where to invest their money. It's frustrating, right? You might be asking yourself, how can I get ahead? Well, it's clear we need effective solutions to these problems. That's where learning from hedge fund strategies can really make a difference. Now, let's explore some specific hedge fund strategies that can help with these money issues. First up, we have diversification. This is all about spreading your investments across different assets to minimize risk. Think of it like not putting all your eggs in one basket. Next is risk management. This involves assessing the risks of your investments and making adjustments as needed, kind of like having a safety net. We have tactical asset allocation. This strategy lets you adjust your investments based on market conditions, so you're not just sitting back and hoping for the best. Let's say you invest in a mix of stocks and bonds, but when the stock market is booming, you shift more into stocks for potential gains. These strategies aren't just for the rich. They can be tailored to fit anyone's financial journey. Let me share a quick story. There's this guy named Mark who was drowning in credit card debt and felt completely lost with his finances. He decided to take control by applying some hedge fund strategies. Mark diversified his investments, focusing on both stocks and real estate. He also got serious about risk management and learned how to adjust his portfolio based on market trends. Fast forward a few months, and he not only paid down his debt, but also started building a solid savings fund. It's incredible how these strategies transformed his financial life. Mark's story is just one example of how we can all apply these concepts to overcome our money problems. Looking at the 5 common problems that many everyday people face, which are financial strain. Many people struggle with financial challenges, including debt, living paycheck to paycheck, and insufficient savings for emergencies or retirement. Mental health issues. Mental health disorders such as anxiety, depression, and stress affect millions of people worldwide, impacting their daily functioning, relationships, and overall well-being. Health and wellness. Maintaining good physical health can be challenging, with issues ranging from chronic conditions like obesity and diabetes to access to affordable health care and healthy food options. Work-life balance. Balancing work responsibilities with personal life can be difficult, leading to burnout, stress, and strained relationships with family and friends. Social isolation. Many people experience feelings of loneliness and social isolation, especially in today's digital age, where meaningful connections can be difficult to cultivate, leading to mental health issues and decreased quality of life. These are just a few examples of the challenges that everyday people may face, and addressing them often requires a combination of individual effort, societal support, and access to resources and services. Let's look at solving the financial problems using alternative investment. Certainly, alternative investments are assets that fall outside the traditional categories of stocks, bonds, and cash. They often have low correlation with traditional investments and may offer unique risk-return profiles. Here's a detailed list of alternative investments. Real estate. This includes direct ownership of properties, real estate investment trusts, REITs, real estate crowdfunding, and rental properties. Private equity. Investments in privately held companies, venture capital, buyouts, and private placements. Hedge funds. Pooled investment funds that employ various strategies to generate returns, including long-short equity, arbitrage, and macroeconomic bets. Commodities, physical goods such as gold, silver, oil, natural gas, agricultural products, and precious metals. Infrastructure, investments in essential infrastructure projects such as toll roads, bridges, airports, and utilities. Private debt, non-traditional lending vehicles such as peer-to-peer lending, direct lending, and mezzanine financing. Art and collectibles, investments in fine art, rare coins, stamps, antique furniture, and other valuable collectibles. Cryptocurrencies, digital or virtual currencies such as Bitcoin, Ethereum, and Litecoin. Managed futures, investments in futures contracts traded on commodities, currencies, interest rates, and equity indexes. Structured products, complex financial instruments such as collateralized debt obligations, CDOs, credit-linked notes, and structured settlements. Royalties, income streams generated from intellectual property rights, including music royalties, patent royalties, and mineral rights. Wine and spirits, investments in high-quality wines, rare whiskeys, and other alcoholic beverages. Timberland, ownership of forests and timber resources for logging and wood production. Farmland, agricultural land used for crop cultivation, livestock farming, and agricultural production. Peer-to-peer lending, online platforms that match borrowers with investors for personal, business, or real estate loans. Film and entertainment, investments in film production, distribution, and royalties from movie and television rights. Carbon credits, tradable permits that allow the holder to emit a certain amount of greenhouse gases used for carbon offsetting purposes. Structured settlements, annuity payments resulting from legal settlements, lottery winnings, or insurance payouts which can be sold for a lump sum. Mineral rights, ownership of rights to extract minerals, oil, and natural gas from underground reserves. Livestock, investments in livestock such as cattle, sheep, and poultry for breeding, meat production, or dairy farming. These alternative investments offer diversification opportunities and may appeal to investors seeking to enhance their portfolio's risk-adjusted returns or hedge against market volatility. However, they often come with higher risks, liquidity constraints, and specialized knowledge requirements compared to traditional investments. Investors should conduct thorough due diligence and consult with financial professionals before allocating capital to alternative assets. Becoming an alternative investment strategist. Looking at becoming an alternative investment strategist requires a combination of education, experience, and specialized knowledge in alternative asset classes. Here's a detailed step-by-step method to pursue this career path. Step 1. Obtain a relevant degree. Pursue a bachelor's degree in finance, economics, business administration, or a related field. Some universities offer specialized programs in alternative investments or alternative asset management. Step 2. Gain industry experience. Seek internships or entry-level positions in financial services firms, investment banks, hedge funds, private equity firms, or asset management companies. Focus on roles that involve exposure to alternative investments, such as research analyst, financial analyst, or investment associate. Step 3. Develop technical skills. Acquire proficiency in financial modeling, data analysis, and quantitative research methods. Learn how to evaluate and analyze alternative asset classes, including real estate, private equity, hedge funds, commodities, and structured products. Step 4. Obtain professional certifications. Consider pursuing professional certifications to enhance your credibility and marketability in the field. Relevant certifications include Chartered Financial Analyst, CFA, Chartered Alternative Investment Analyst, CAIA, Financial Risk Manager, FRM, Certified Private Equity Professional, Certificate in Quantitative Finance, CQF. Step 5. Stay updated on industry trends. Stay abreast of developments in alternative investments, including regulatory changes, market trends, and emerging asset classes. Attend industry conferences, seminars, and workshops to network with professionals and expand your knowledge base. Step 6. Build a professional network. Cultivate relationships with industry professionals, including fund managers, institutional investors, financial advisors, and other alternative investment strategists. Join professional organizations such as the Alternative Investment Management Association, IMA, or the CAI Association to connect with peers and access resources. Step 7. Develop a specialized expertise. Focus on a specific area within alternative investments such as real estate, private equity, or hedge funds. Conduct research, publish articles, or present at conferences to establish yourself as an expert in your chosen niche. Step 8. Pursue advanced education. Optional. Consider pursuing a master's degree or advanced certifications in finance, economics, or a specialized area of alternative investments. Advanced education can deepen your expertise and open up opportunities for career advancement. Step 9. Gain leadership experience. As you progress in your career, seek opportunities to take on leadership roles, such as team leader, portfolio manager, or department head. Demonstrate your ability to lead and mentor junior colleagues and contribute to the strategic direction of your organization. Step 10. Stay committed to professional development. Continuously seek opportunities for professional development and skill enhancement. Stay adaptable and open to learning new technologies, methodologies, and investment strategies to remain competitive in the field. By following these steps and continually investing in your education and professional development, you can pursue a successful career as an alternative investment strategist. Remember that success in this field requires dedication, hard work, and a passion for exploring innovative investment opportunities. Specializing in private equity and hedge funds requires a combination of education, experience, and specialized knowledge in alternative investments. Here's how you can specialize in these areas. 1. Obtain a relevant education. Pursue a bachelor's degree in finance, economics, business administration, or a related field. Some universities offer specialized courses or concentrations in alternative investments. Consider pursuing advanced degrees such as a Master of Business Administration (MBA) with a focus on finance or a Master of Finance (MFin) program. 2. Gain industry experience. Seek internships or entry-level positions in financial services firms, investment banks, or asset management companies that specialize in alternative investments. Look for roles that provide exposure to private equity, hedge funds, or related areas, such as investment analysis, due diligence, or fund management. 3. Learn about alternative investments. Study the principles and practices of private equity and hedge funds, including their investment strategies, valuation techniques, risk management approaches, and regulatory considerations. Familiarize yourself with different types of alternative investment structures, such as limited partnerships, private placements, and fund of funds. 4. Obtain professional certifications. Consider pursuing professional certifications relevant to private equity and hedge funds, such as Chartered Financial Analyst (CFA), Chartered Alternative Investment Analyst (CAIA), Certificate in Investment Performance Measurement (CIPM). These certifications demonstrate your expertise and commitment to the field and can enhance your credibility with employers and clients. 5. Develop technical skills. Acquire proficiency in financial modeling, data analysis, and quantitative research methods. Learn how to evaluate investment opportunities, conduct due diligence, and assess risk-return profiles for private equity and hedge fund investments. 6. Build a professional network. Cultivate relationships with industry professionals, including fund managers, investors, and advisors specializing in alternative investments. Attend industry conferences, seminars, and networking events to expand your network and stay updated on industry trends. 7. Gain hands-on experience. Seek opportunities to work on real-world projects or assignments related to private equity and hedge funds. Volunteer for research projects, participate in investment competitions, or collaborate with professionals on industry-related initiatives to gain practical experience and build your portfolio. 8. Stay informed and adaptive. Stay abreast of developments in the private equity and hedge fund industry, including regulatory changes, market trends, and emerging investment opportunities. Continuously update your skills and knowledge through professional development, self-study, and participation in industry forums and discussion groups. By following these steps and investing in your education, experience, and professional development, you can specialize in private equity and hedge funds and pursue a rewarding career in alternative investments. Remember to stay committed to lifelong learning and adaptability to thrive in this dynamic and competitive field. Let's look at the principles and practices of private equity and hedge funds, including their investment strategies, valuation techniques, risk management approaches, and regulatory considerations. Private equity and hedge funds operate within distinct investment frameworks, each with its own set of principles, practices, and considerations. Here's an overview of the key aspects of both private equity and hedge funds. Private equity, investment strategy. Private equity firms invest in privately held companies with the goal of improving their performance, growing their value, and ultimately realizing a profitable exit. Common strategies include leveraged buyouts, LBOs, where firms acquire companies using a combination of equity and debt financing, and venture capital, VC, which focuses on early-stage and high-growth companies. Valuation techniques. Private equity investors use various valuation methods to assess the value of target companies, including discounted cash flow, DCF analysis, comparable company analysis, CCA, and precedent transactions analysis. Valuation also considers factors such as industry trends, growth prospects, competitive positioning, and potential synergies. Risk management. Private equity investments are subject to various risks, including operational, financial, and market risks. Risk management involves thorough due diligence, active portfolio management, and implementing value-enhancing strategies to mitigate risks and maximize returns. Strategies may include improving operational efficiency, optimizing capital structure, and executing growth initiatives. Regulatory considerations. Private equity firms must comply with regulatory requirements related to securities laws, antitrust regulations, and investor protection laws. Regulations vary by jurisdiction and may impact fund structuring, fundraising activities, disclosure requirements, and investor relations. Hedge funds, investment strategy. Hedge funds employ a wide range of investment strategies, including long-short equity, global macro, event-driven, quantitative, and arbitrage strategies. The goal is to generate absolute returns regardless of market conditions by taking both long and short positions in various asset classes. Valuation techniques. Hedge funds use sophisticated valuation models and techniques to analyze securities, derivatives, and other financial instruments. Quantitative models, statistical analysis, and proprietary algorithms may be employed to identify investment opportunities and assess risk-return profiles. Risk management. Hedge funds employ rigorous risk management practices to monitor and manage portfolio risk. Strategies may include diversification, hedging, leverage control, position sizing, and scenario analysis to mitigate downside risk and preserve capital. Regulatory considerations. Hedge funds are subject to regulatory oversight by securities regulators, such as the Securities and Exchange Commission, SEC, in the United States, and the Financial Conduct Authority, FCA, in the United Kingdom. Regulatory requirements may include registration, reporting, disclosure, and compliance with anti-money laundering, AML, and Know Your Customer, KYC regulations. Overall, private equity and hedge funds play important roles in the financial markets, offering investors access to alternative investment opportunities with the potential for enhanced returns and portfolio diversification. However, both asset classes involve inherent risks and complexities that require careful consideration and expertise to navigate effectively. So to wrap things up, today we covered some key hedge fund strategies like diversification, risk management, and tactical asset allocation. These approaches can really impact your personal finance game. Remember, solutions are out there, and you don't have to feel stuck in a financial rut. Now I want to hear from you. What money issues are you facing? Or what are your thoughts on using hedge fund strategies? Drop your comments below. And hey, don't forget to check out my next video for more awesome financial insights. Thanks for watching, and see you next time.